The Tesla inclusion of the S&P has been speculation for the last couple of days. I want to talk about this in this episode. This is the Not Even Wrong podcast. It's September 10th, 2020. I am Krim Delco, and the fund today was up 1.5%. For the year, we are up 167%. The market is up roughly 4% for the year, 3.5%, 4%. So we're talking about a 163% outperformance for the year for Orange Capital Partners. Now let's get right into it. Tesla has been in the news recently for S&P inclusion, and there's been a lot of speculation about should they be included and how they should be included and what it all means. And I want to go step by step. It's actually supposedly just a technicality, but it turned into this obsession. And if you really think about it, actually, it is a very interesting case study. So let's go step by step. First of all, the S&P 500 is a massive index because everybody who follows the US economy, the US stock market, is either directly invested in the S&P 500, that's called an index tracker, so somebody just doesn't think much about what to do and just invests their money into the S&P 500 passively. Or there are so-called active investors, investors who try to pick stocks and assets, or even hedge funds who do multi-asset investing, long, short, all that stuff. But they also use the S&P 500 as a benchmark. So that means they measure their own performance based on the development of the S&P 500. So regardless of that, it creates a massive attention if you are in the S&P 500. Now with Tesla, it's very interesting because Tesla is already a very large cap, and that's very unusual. Typically, if you're included in the S&P 500, the way it typically works is you're a company, you've been around for years, and you have to meet the profitability criteria, which is you have to be profitable for 4 quarters in a row, and then you get included at some point into the S&P 500. Now, when I say typically, what I mean is that typically companies get to profitability, but they're relatively small. A normal-sized company, a normal-paced company, even after profitability, it takes a couple of years maybe to be included because they're relatively small, typically. Emphasis on the word typically. With Tesla, there were 2 vectors went exactly the opposite direction. First, they weren't profitable for a while, but then they became profitable, and they became profitable 4 consecutive quarters in a row, which is a condition for an S&P 500 inclusion. But what's more dramatic with Tesla is that in the same time, they also increased dramatically in market cap. And the reason is actually because they turned profitable, also the market cap went up. Now, what happened with Tesla in reality is a lot more complicated. Tesla is a disruptive company. Tesla is a agglomeration of startups, or how do you say, a mix of startups that each one first is working serially, but also in parallel to disrupt dramatically large industries such as transportation, energy, cars, etc. So what we're looking at here is a company which for a while was considered crazy to try to do what they do, then became profitable, cash flow neutral to positive. That means not just that they're crazy, but they're actually able to finance their own stuff. And with that, the way Wall Street works is they're saying, look, the bankruptcy risk has gone down dramatically, but the upside is now even much bigger because they've shown to some extent that they know what they're doing. So long story short, we jack up the market value, and the market value went up from 40 billion to 400 billion. We had a 10x within 12 months. So what you're looking at as a S&P 500 index committee now, which is the people who actually decide who gets into the index and who doesn't, you're looking at a situation where you are admitting a company that is new but also large and has enormous growth potential. So now you're in a position where if you include them, everybody has to start buying Tesla to be exposed, like I said before, either as a passive investor or as a benchmark type investor. No matter what, you are kind of forced to buy some Tesla. So what that creates is a dynamic that's called front running, which is people are anticipating other people buying, so they buy in front of them with the hope that the price goes up so they can sell it to them. These are all, of course, speculative arguments. Nobody has any fundamental proof, or there's no such thing as a front runner fund that does that or anything like that. But we can expect from a sort of dynamic game theoretic type analysis in the stock market that is what's happening in the market. So now, as an index committee, you have this situation where you're thinking, okay, look, if I admit them, then everybody else has to buy. They've been profitable for 4 quarters, so that means they are eligible, but maybe I should wait a little bit just to see that they really have a substantial business model. On the other hand, also, maybe I should wait a little bit because maybe the stock went up too fast, too high. Maybe it could correct a little bit. But what I'm alluding to here is already the situation that I think the S&P 500 committee absolutely doesn't want to be in. The last thing they want to do is start picking the stock, the timing, the level. You don't want to be in this position. And this is my analysis. This is the topic of this episode. You don't want to be in the position of timing Tesla stock in the short term. Even professional, active managers with years and years of experience, with knowledge of the massive volatility that this can create, with knowledge of the intricacies of the stock, with all the knowledge that comes with analyzing specific stocks like Tesla, even those types are very, very reluctant to bet on timing and levels. And I think the same applies absolutely, almost by definition, to people like index committees or passive investors. So my point is that the best thing for passive investors is actually to stay away completely from the speculation here, to just put on a rule, which is as long as the stock is not in the index, I'm not going to do anything. And as soon as the stock is in the index, I'm just going to buy the amount of index I need to buy, and that's it. I'm going to be done with it. I'm not going to speculate here. I'm not going to try to time anything. This, in my opinion, is the best way to deal with this stock. And this brings me to us, Orange Capital Partners, and the way we're dealing with this, which is exactly the same way. Now, we're not a passive index tracker by no means. We're a very active, highly concentrated investor. Our purpose is to generate wealth by investing in disruptive technologies with large impact. Our purpose is to generate wealth. So we have a mandate given to ourselves that we want to outperform pretty much any index out there you could name, because we want to generate wealth. We don't just want to have a relative outperformance. So for that, we have to have certain rules in place. And the same way that I said, actually, for index trackers, the same applies to us. The best way to avoid disturbance, schizophrenic behavior, craziness, emotional ups and downs, you name it, is to set rules in advance and follow those rules diligently. And the rules we set is that we don't try to time short-term events in the stock. In fact, we have criteria. We are not just blindly long Tesla, don't get me wrong. But the criteria have nothing to do with the stock. In fact, I would say they have zero to do with the stock. The criteria are all fundamental business-related criteria. I've mentioned several times on this podcast that we have 3 theories that we base our fund on. The disruptive innovation theory by Clayton Christensen, as written down in The Innovator's Dilemma. We have the innovation stack by Kevin McKelvey, and is it Kevin? I always miss that name. Jim McKelvey. I'm so sorry. It's Jim McKelvey. And 0 to 1 by Peter Thiel. Those are the 3 books that we base our theory on. And I want to be very, very clear about this. This is not just some intellectual gibberish. It is very important to know what kind of concept you're even basing your thinking on. And these are the concepts. So let me give you an example. If we start seeing behavior in the competitive landscape which doesn't follow the innovator's dilemma concept, which is, disruption is a theory of competitive response. And part of that competitive response is, for example, that the incumbents, A, ignore the disruptor, and B, also behave in a way that they're complacent, nonchalant, etc. As long as we see that, and this is exactly what we're seeing right now, we're very comfortable with the competitive situation within Tesla. Another example is, let's say, Jim McKelvey's innovation stack talks about the innovation stack, which is, create a problem, solve a problem, create new problem, solve a problem. As long as we see Tesla doing that and successfully solving problems, which translates into a very high R&D efficiency and a very high also execution rate, as long as we see that, there's no reason for us to be concerned. 0 to 1 is more of a cultural book, which talks about the culture, for example, the question, what is the minimum amount of people you need for a startup, and how do you build a startup around a monopoly, which doesn't look as a monopoly in the first place, but is a monopoly. For example, Tesla built a monopoly in luxury electric cars, but that was a market that nobody cared about because everybody only cares about the big car market. So you have this ability to grow and become a massive player in a new market and then have a monopoly in that market. So as long as we see all these factors falling into place, there's absolutely no reason for us to be concerned. If we saw that all of a sudden some of these factors don't play anymore, that Tesla is not fitting into those theoretic concepts, then we would have to start rethinking our investment thesis and potentially even get out. So again, I just want to emphasize, this has nothing to do with the stock level. The stock level is a measurement of value. It's important. It's a benchmark. It's, of course, also the way we actually end up generating wealth. But it's not something we use to aggregate information about should we buy or should we not buy. And we, as a fund, are permitting cash flow, always buyers of the stock. In fact, to the point where we'd rather not buy a house than buy a stock, because using capital for a house would, given the expected returns that we see in the stock, will make this house that we potentially will buy very expensive. So this is just a small example I want to give to be clear about how dedicated we are to this thesis and how reluctant we are at this point also not to own Tesla stock. So to summarize, the S&P 500 inclusion in our view is a foregone conclusion. It will happen. It will happen at some time. It is up to the index committee to decide that. This is not something we want to engage in speculation in. It is up to them. They will have to at some point do it, because also it's a competitive question for them. If they don't include Tesla, but let's say MSCI does, then maybe people would start switching to other indices, and it could even derail the S&P 500. This is exactly how the Dow Jones got derailed by the S&P 500. So this is a serious issue. This is not just some not just some little technical question or something. This is a serious question that if I was the S&P 500, I would spend some time thinking about this very, very thoroughly. Nevertheless, for us investors at Orange Capital Partners, this is in fact almost a non-event. It's interesting to think about it. Like many things in the life of Tesla, sometimes it's just worth thinking about it, even though it doesn't have actionable results for us. We think that Tesla will be included, that there will be short-term volatility around this inclusion, that in the long term, though, that is completely irrelevant. We have a small recommendation to fund managers to not be involved too much in the speculation of when it will happen, because that is just almost impossible to predict, and therefore we suggest that they just follow a very clear rule, which is you buy it whenever it's included. Thank you.